Have you noticed something strange? A few years ago, your banking app was trying to feel more like a technology company. Now your technology apps are trying to feel more like banks. You open a shopping app and it offers credit. You open a ride-sharing app and it offers a wallet. You open a social media platform and it wants to handle payments. Even food delivery apps are quietly introducing financial products. And at first it seems convenient. Why wouldn't you want everything in one place? But there's a deeper question hiding underneath all of this. Why does every app suddenly want to hold your money? Because if all these companies are supposedly in different industries, why are they all racing toward the same destination? The answer has less to do with technology than most people realize. And much more to do with human psychology, because in the modern economy, attention is valuable. But your money is even more valuable. And once a company controls where your money lives, it often starts influencing where your attention goes next. That's where this story begins. For most of modern history, banking was boring. And that was kind of the point. Banks weren't designed to entertain you. They weren't supposed to compete for your attention. Their role was relatively simple. Store money, move money, lend money. That was the deal. But over the last 20 years, something changed. The internet transformed almost every industry into a competition for engagement. Companies learned that if they could keep users inside their ecosystem longer, they could earn more revenue. Streaming services wanted more viewing hours. Social platforms wanted more screen time. Shopping platforms wanted more purchases. Everyone was fighting for a larger share of your day. But eventually many companies discovered a frustrating limitation. Attention is difficult to monetize consistently. Money is easier. Think about it. You might open a shopping app once a week. You might order food a few times a month. But money? Money moves through your life every single day. Every paycheck. Every bill. Every subscription. Every purchase. Money isn't an occasional interaction, it's a constant one. And businesses noticed. Suddenly the goal wasn't just getting you to use the platform. The goal became becoming part of your financial infrastructure. Because infrastructure is powerful. When a company becomes part of your routine, it gains influence. When it becomes part of your finances, it gains something even stronger, dependence. That sounds dramatic. Dependence. That sounds dramatic, but think about how difficult it is to switch banks. Now imagine an app that handles your payments, savings, rewards, subscriptions, and credit. Leaving becomes harder. Not because you're trapped. Because convenience creates inertia, and inertia is one of the strongest forces in consumer behavior. We often imagine our financial decisions as rational calculations. But many of them are actually emotional shortcuts. We choose what's familiar. We stay with what's familiar. We stay with what feels easy. We avoid friction, even when better alternatives exist. This is one reason companies are so eager to build financial products. The more financial relationships they create, the more deeply they become woven into everyday life. And here's where things get interesting. Most people assume these companies are competing for customers. In reality, many are competing for something much more valuable. Data. Because money tells stories. Every transaction becomes a tiny piece of behavioral information. What you buy, when you buy, how often you spend, what stresses you, what excites you, what you're planning for, what you're worried about. Your bank statement can sometimes reveal more about your life than your social media profile. And in a data-driven economy, understanding behavior is incredibly valuable. Not necessarily because companies are plotting something sinister, but because prediction is profitable. The more accurately a company can predict your behavior, the more effectively it can market products, retain customers, and generate revenue. Which creates a fascinating feedback loop. The more financial activity happens inside one ecosystem, the more that ecosystem learns. The more it learns, the more personalized it becomes. The more personalized it becomes, the harder it feels to leave. Little by little, convenience turns into attachment. Not emotional attachment. Behavioral attachment. And most of the time, we barely notice it's happening. But there is another layer to this story. One that has less to do with technology and more to do with uncertainty, because modern life feels financially fragile for many people. Rent increases. Inflation concerns. Job insecurity. Unexpected expenses. The cost of simply existing seems to rise every year. For a lot of people, money no longer feels like a tool. It feels like a source of constant background anxiety, and companies know this, so financial features are increasingly marketed not just as services, but as solutions to emotional discomfort. Buy now, pay later. Instant credit, early paycheck access, flexible payments, emergency borrowing. These features often address real needs. But psychologically, they do something important: they reduce immediate pain. The problem is that reducing immediate pain isn't always the same thing as solving long-term problems. Humans are naturally wired to prioritize present relief over future consequences. Behavioral economists call this present bias. Most of us simply experience it as being human. When financial pressure appears today, tomorrow becomes less important. That's understandable, but it also creates opportunities for companies that position themselves as the fastest source of relief. Which helps explain why so many platforms are moving toward financial services. Not because they're becoming banks in the traditional sense, because they're becoming intermediaries between people and financial stress. And that's a very influential position to occupy. At this point, it might sound like all of this is bad. But that's not really the lesson. Some financial innovations genuinely improve people's lives. Digital payments are faster. Transfers are easier. Access has expanded. Many services solve real problems. The issue isn't that apps want to become financial platforms. The issue is understanding why. Because once you understand the incentives, the landscape starts looking different. You stop seeing random features. You start seeing strategy. You realize that every company is trying to answer the same question. How do we become essential? Not useful. Essential. Not useful. Essential. Useful is optional. Essential is recurring. And recurring relationships tend to generate recurring revenue. That's the economic logic underneath much of the digital world. The turning point comes when we stop viewing convenience as automatically neutral, not because convenience is bad, because convenience always has direction. It shapes behavior. Every system encourages certain actions while discouraging others. Every interface quietly nudges decisions. Every financial product influences habits. The question isn't whether we're being influenced. We always are. The question is whether we're aware of it. Because awareness creates choice, and choice creates freedom. Maybe the healthiest response isn't rejecting these tools. It's using them consciously. Understanding what problem they're solving. Understanding what incentives exist behind them. Understanding when convenience is helping us and when it's quietly making decisions for us. Financial resilience rarely comes from finding the perfect app. It comes from understanding your own behavior. Your fears, your habits, your impulses, your relationship with uncertainty. The more aware you become of those things, the harder it becomes for external systems to control them. And perhaps that's the strange irony of this entire trend. As companies race to become more deeply embedded in our financial lives, the most valuable skill remains remarkably old-fashioned. Paying attention, not to the apps, not to the advertisements, not to the advertisements, not to the advertisements and no features, but to ourselves. Because money has never been just about numbers, it's about security, control, possibility, peace of mind. And no matter how advanced technology becomes, those needs remain deeply human. Maybe that's why every app wants to become your bank, not because money is the product. Because money sits at the center of so many human emotions. And wherever human emotions gather, business opportunities tend to follow. The technology will keep changing. The platforms will keep evolving. New financial products will appear, old ones will disappear. But the underlying question remains the same. Who influences your financial decisions? And how much of that influence are you actually aware of? Sometimes the most important financial skill isn't earning more, or investing better, or finding the perfect platform. Sometimes it's simply recognizing when convenience is shaping choices you thought were entirely your own. And once you notice that, you start seeing the modern economy a little differently. Not with fear, not with cynicism. Just with clearer eyes.